Two retirees, same $1 million, same investments, same 30-year average return of 7%. One runs out of money at 79, the other dies with nearly $2 million. The difference isn't how much they earned, it's when they earned it. After working with hundreds of affluent retirees here in Virginia and across the United States, I've seen this scenario play out in real life, and most people have never heard of the risk that caused it. So here's the uncomfortable truth. You could do everything right for 30 years, max out your 401k, invest wisely, avoid emotional mistakes, and still have your retirement derailed by something completely outside your control. It's called sequence of returns risk. And if you're within 10 years of retirement, this might be the most important risk you've never considered. Hi, I'm Mark Fonville, CEO and Certified Financial Planner here at Covenant Wealth Advisors in Richmond, Virginia. Today, I'm going to walk you through three things. First, I'll show you exactly how sequence risk works with real numbers that make it impossible to ignore. Second, I'll share 6 specific strategies that can help protect your portfolio during the years when you're most vulnerable. And third, I'll reveal a counterintuitive approach at the end that flies in the face of traditional advice but has been shown in academic research to actually improve retirement outcomes. And be sure to stay until the end. The last strategy is the one most advisors never mention. In a few minutes, I'm going to introduce you to 2 hypothetical retirees. Let's call them Barney and Lisa. Both start with $1 million. Both earn the exact same returns over 20 years, but one runs out of money completely while the other ends up with nearly $2 million. When you see the math, you'll understand why the conventional wisdom of just stay invested for the long term may not be enough once you start taking withdrawals. Before we dive into the strategies, let me make sure we're clear on something fundamental that a lot of people misunderstand about investment returns. When you're saving for retirement, when you're in your 40s and 50s and you're adding money every month, market volatility is actually your friend. If the market drops, you're buying more shares at lower prices. When it recovers, you benefit. This is dollar cost averaging, and it works in your favor during accumulation. But the moment you retire and start taking withdrawals, the math completely changes. Now every dollar you pull out during a market downturn is a dollar that won't be there to participate in the eventual recovery. And if you experience a significant decline in those first few years, what I call the fragile decade, the damage can be substantial and potentially permanent. Let me show you exactly what I mean. Before I walk through this comparison, I want to be clear. This is a hypothetical illustration for educational purposes only. It does not represent actual client results, and your individual experience will vary based on your specific circumstances, market conditions, and many other factors. So now picture 2 retirees, Barney and Lisa, both retire at 65 with exactly $1 million. Both plan to withdraw $50,000 per year, increasing by 2.5% annually to keep pace with inflation. And over the next 20 years, both portfolios experience the exact same set of annual returns, averaging about 7%. The only difference, the sequence of those returns. Barney's returns are Lisa's returns, just in reverse order. Let's start with Barney. He gets it with a rough sequence early, a 12% loss in year 1, an 8% loss in year 2, then another 10% drop in year 5. You can see his portfolio steadily eroding. By year 10, he's down to just $240,000, and even though the market recovers with strong returns in years 11 through 14, it's too late. The damage is done. In year 15, Barney takes his last withdrawal, just $23,000 in his portfolio hits zero. Now look at Lisa, same returns, just reversed. She gets 25% in year 1, 22% in year 2, building a cushion that carries her through the inevitable down years later. By year 10, her portfolio has grown to over $3 million. So when those negative returns finally show up in years 16 through 20, she can absorb them. She ends 20 years of retirement with nearly $2 million. Here's where it really hits home. Same returns, same average, completely different outcomes. Barney runs out of money at 79, while Lisa withdrew over $1.2 million in income and ended with nearly $2 million in the bank. So let me say that again. Both investors earned the same 7% average return. Both withdrew the same amounts, but one ran out of money and the other nearly doubled her wealth. This is sequence of returns risk in action. Now, here's the research that really drives this home. Wade Pfau, one of the leading academics in retirement income research, found that approximately 80% of your final retirement outcome can be explained by the cumulative portfolio returns and inflation in just the first 10 years, not your entire retirement, just the first decade. That's why I call it the fragile decade. Those first 10 years aren't just important, they can be decisive for everything that follows. So I'm curious, had you heard about sequence of returns risk before watching this video, or is this concept new to you? Drop a comment below, I read every single one. So what do you actually do about this? You can't control what the market does in your first 10 years of retirement, but you can control how you structure your portfolio and your withdrawals to potentially minimize the damage if bad returns show up early. I'm going to walk you through 6 strategies, starting with the most straightforward and then moving to more sophisticated approaches. Some you can implement yourself, others really benefit from professional guidance. The first strategy is building what I call a cash reserve bucket. The concept is simple. Keep enough in cash and short-term bonds so you don't need to sell stocks during a down market. Charles Schwab's research team recommends keeping about 1 year's worth of expenses after accounting for Social Security and any pension income in actual cash or cash equivalents. Then another 2 to 4 years worth in what we call high quality short-term bonds. So if you need $50,000 a year from your portfolio and Social Security covers $25,000, you'd want about $25,000 in cash and somewhere between $50,000 and $100,000 in short-term bonds. That gives you 3 to 5 years of runway before you'd need to touch your stock allocation. The psychological benefit here is significant. When the market drops 30%, you're not panicking because you have years of expenses set aside in stable assets. You can let your equities recover. The second strategy is flexible spending, and this one is surprisingly powerful. Vanguard's research shows that making a modest spending cut of just 2.5% during down years can increase your portfolio's probability of lasting throughout retirement by over 30%. Here's what this looks like in practice. Instead of withdrawing a fixed dollar amount, regardless of what the market does, you build flexibility into your spending plan. Maybe you have a baseline budget and a belt tightening budget. In years when your portfolio drops significantly, you pull from the belt tightening version. Delay the kitchen renovation, take a less expensive vacation, keep the older car another year. This isn't about living in deprivation, it's about having the flexibility to absorb temporary setbacks without permanently impairing your portfolio. William Bengen, the researcher who developed the original 4% rule back in 1994, recently updated his research and found that flexible withdrawals can support a withdrawal rate of 4.7% compared to the traditional 4% guideline, but only for retirees willing to adjust when markets are rough. If you're finding this valuable, take a moment to like this video and subscribe. We put out content regularly on retirement planning, tax strategies, and investment management for people approaching or already in retirement. So the third strategy is what retirement researchers call a bond tent. And this one is counterintuitive. Traditional advice says to gradually get more conservative as you age. Reduce your stock allocation by 1% or 2% every year throughout retirement. But research from Michael Kitces and Wade Pfau suggests a different approach. The bond tent works like this. In the 5 to 10 years before retirement, you deliberately increase your bond allocation, maybe from 40% up to 60 or even 70%. You're building extra protection heading into the danger zone. Then in the first decade of retirement, the fragile decade, you gradually just spend down that bond allocation to fund your withdrawals, allowing your stock allocation to drift back up. By year 10 or 15, you might be back to a more aggressive allocation than you started with. So why does this work? Because you're reducing volatility precisely when sequence risk is highest, when your probability is at its peak value and you're most vulnerable. Then, once you've survived the fragile decade, you can afford to take more risk again. And by the way, this brings us to strategy 4, which is really the other side of the bond tent. It's called the rising equity glide path. Here's what most target date funds get backwards. They assume you should get more conservative every single year throughout retirement. But the Kitces and Fowl research published in the Journal of Financial Planning found that starting with lower equity exposure and increasing it over time actually produced better outcomes in historical simulations than the conventional declining glide path. The logic makes sense when you think about it. If you survive the fragile decade with your portfolio intact, the sequence risk has largely passed. At that point, you want enough growth to sustain what could be 20 or more years of retirement. This isn't a set it and forget it strategy. It requires monitoring and adjustment. But the core insight that always get more conservative may not be optimal is worth understanding. So let me show you how these strategies work together with a hypothetical example. Meet Robert and Susan, both 63, both planning to retire in the next couple of years. They've saved $2 million for retirement. They estimate they'll need about $90,000 a year to maintain their lifestyle. Between the two of them, Social Security will cover about $38,000 of that, which means they'll need to pull about $52,000 a year from their portfolio. Here's how they might build their fragile decade protection plan. First, they set aside about $100,000 in cash and short-term bonds, enough to cover roughly 2 years of withdrawals without touching their stocks. Second, they shift their portfolio a bit more conservative before retirement, moving from 55% stocks down to 40%. That's their bond tent. And third, they get honest about flexibility. They identify about $12,000 a year in discretionary spending, travel, home projects, new cars that they could scale back temporarily if markets drop hard in their early retirement years. And fourth, they agree on a withdrawal sequence. Draw from bonds and cash in down years, rebalance in good years. If you're married, by the way, this is exactly the kind of planning you want to think through together. Robert and Susan made these decisions as a team, agreeing on their flexibility thresholds before retirement, not in the middle of a market panic. The result, even if they retire into a 2008 style crash, they have multiple levers to pull. They're not forced to sell stocks at the bottom. They can trim discretionary spending temporarily, and they have a clear plan for getting back into equities when markets recover. So which of these strategies are you considering? Or are you already using some version of the cash reserve bucket or flexible spending approach? Let me know in the comments below. I generally like to hear what's working for you now. Now, finally, the fifth strategy involves Social Security timing, and this one comes with an important nuance most people miss. You've probably heard the conventional wisdom, delay Social Security as long as possible, ideally until 70 to maximize your benefit. Mathematically, if you can afford to wait, that often makes sense. You get roughly 8% more benefit for every year you delay past your full retirement age. But here's what most people don't consider. Delaying Social Security means you're taking more from your portfolio during those early years. And if those early years coincide with poor market returns, you could be amplifying your sequence risk, not reducing it. This is a case where the right answer depends heavily on your specific situation. If you have a large portfolio, a pension, or other guaranteed income, delaying Social Security often makes sense. But if your portfolio is your primary income source and you're concerned about sequence risk, there's an argument for claiming Social Security earlier and reducing portfolio withdrawals during the fragile decade. When we run the numbers using our tax planning software, we can model different scenarios, claiming at 62, 67, or 70, and see how each affects your probability of portfolio success under various market conditions. The optimal choice isn't always what people expect. And the sixth strategy, by the way, is what Morningstar calls the Guardrails method. And it's the most sophisticated approach we'll discuss. And here's how it works. Instead of setting a fixed withdrawal rate and hoping for the best, you establish upper and lower boundaries, or what we call guardrails, around your spending. If your portfolio grows significantly, you can increase spending. If it drops significantly, you can cut back. Morningstar's 2025 research found that this approach can support a starting withdrawal rate of around 5%, well above the traditional 4% guideline, while still maintaining a high probability of success in their historical simulations. The trade-off is that your income varies more year to year. But if you have Social Security or a pension providing a baseline income floor, the Guardrails approach lets you spend more during good years and less during bad ones, which is exactly what sequence risk management is designed to accomplish. Now, there are a few technical issues that can complicate these strategies. The first is taxes. The account you withdraw from can significantly impact your tax bill and your Medicare premiums. Taking too much from traditional IRAs can push you into higher tax brackets or trigger IRMA surcharges on Medicare. A Roth conversion strategy done in the years before you start Social Security can help reduce your sequence risk by giving you tax-free funds to draw during market downturns. But the timing and amounts matter enormously. The second issue is required minimum distributions. Starting at age 73, you're required to withdraw from traditional retirement accounts, whether you need the money or not. And this can complicate your withdrawal sequencing if you're forced to sell stocks during a down market to meet your RMD. Planning around RMDs should start well before you reach 73. The third consideration is behavioral. These strategies only work if you actually follow them. The bond tent doesn't help you if you panic and sell your stocks at the bottom anyway. The flexible spending approach doesn't work if you refuse to cut back when markets drop. The research is clear, but implementation requires discipline and often accountability from someone who isn't emotionally invested in the same outcome you are. So let me go ahead and step back and share what this really comes down to for you. The fundamental insight is this: retirement planning isn't just about accumulating the largest possible portfolio. It's about managing risk, particularly the risk that shows up at the worst possible time. The Fragile Decade framework reframes how you should think about those crucial years around retirement. It's not about maximizing growth anymore. It's about building resilience, about reducing the probability that a bad sequence of returns derails 30 years of careful saving. According to the 2025 EBRI Retirement Confidence Survey, almost half of retirees say they spend less than they could because they're worried about running out of money. That fear is understandable, but with proper planning, it doesn't have to control your retirement. The strategies we've discussed today exist so you can spend your money with greater confidence, knowing you've taken steps to manage the risk that matters most. So if you're within 10 years of retirement or in your first decade of retirement, here's what I suggest you consider. First, assess your current exposure. Do you have adequate cash reserves? How much of your portfolio would you need to liquidate during a significant market decline? Second, stress test your plan. Run the numbers under different scenarios. What happens if you retire into a 2008 style decline, a 2000 to 2002 style decline? How long could you sustain withdrawals without selling stocks? Third, consider your flexibility. Identify discretionary expenses you could reduce temporarily. Have an honest conversation with your spouse about what belt tightening would actually look like for your household. Fourth, recognize when this gets complicated. Social Security, timing, tax implications, RMD planning, and behavioral discipline all interact in ways that are difficult to optimize on your own. There's real value in working with a fiduciary advisor who specializes in retirement income planning, someone who can run the projections and help you stay the course when markets get rough. So if you found this valuable, send it to your spouse. Seriously, this is exactly the kind of conversation you should be having together before retirement, or if you're already retired, before the next market downturn. The strategies we discussed today affect both of you. If you are single, share it with a friend. Watch it together and talk about which approaches fit your situation. And if you'd like to see how this applies to your specific circumstances, we offer a complimentary retirement strategy session. We can discuss your portfolio's potential vulnerability to sequence risk and discuss different scenarios for your first decade of retirement. There's no obligation, just a clear conversation about your options. If that's of interest to you, visit covenantwealthadvisors.com to schedule, or just use the link in the description below. Thanks so much for watching. Have a good one.